wanted to quickly look at a couple of, I'll call them institutions, places that people think are banks or think they are good financial institutions, but we're going to see in a moment here why this is probably not a good idea. Um, you may see these on TV or in your neighborhood, but we're going to kind of illustrate right now that this is not great. I want to really quickly look at something called a pawn shop, loan sharks, check cashing centers, and debt consolidators. First, we'll start with pawn shops. I don't know if anyone has ever seen the show Pawn Stars on the History Channel. Um, uh, they're famous. If you check it out, they're still out there. I think you can see them on replays. Um, Shop in Las Vegas, and you may have seen kind of how this show goes. People bring in items and they try to sell them usually, and the guys go through and make a deal for them, and they usually tell you a little bit about the history of the item. But here's really how a pawn shop works. Okay. First, when you walk into the pawn shop, you have two options. You can bring an item with you, and you can either just sell the item outright for cash, or you can borrow money from the pawn shop with interest. Because again, the rule of money says that you can't use someone else's money without paying for it, or if you use someone else's money, you have to pay for it. So if you're going to borrow their money, you need to pay them interest. Okay. What they're going to do is, let's say you're going to get money, you're going to get a loan from them. What they're going to do is they're going to hold on to your valuable. So if I pawn my cell phone, I would have to give them my cell phone until I paid back for the loan. This, in financial terms, is called collateral. It's a security pledged for the repayment of the loan. When I was in high school, if we wanted to go, let's say, to the bathroom from the cafeteria, we usually had to hand to the teacher or the person standing at the door my wallet, my ID card, something of value to me. That was to guarantee you actually came back from the bathroom and didn't go hang out somewhere. Well, if you're going to borrow money from a place, they may say, yeah, we don't really know you very well. I don't necessarily trust you. So to make sure I get my money back, I'm going to take something of value from you. That's called collateral. That's the financial term here. So maybe they'll give you a short time frame to maybe repay the loan, maybe 30 days, 60 days. We're not talking about a 30-year mortgage here. We're talking about a very short time frame. And generally, if you are taking out a loan and you pay the loan back to them in time with interest, they'll return back to you your item, your valuable. If you don't pay them back on time or don't pay them back at all, they keep your item and they can now sell it to be able to make money or get back the money that you didn't pay them from the loan. Okay, a couple of problems here I have with this. So maybe here's an example. You're hard up for cash and you have a gold ring, pretty standard gold ring that really could be valued maybe at about $300. Now you bring it to the pawn shop and you now try to pawn this item. Unfortunately, they're not going to give you $300. Even though that's the price of the item, they're not going to give you $300. Maybe he'll offer you $50 for it. Think about it. He has to, the pawnbroker, the guy who runs a pawn shop, has to be able to, if you don't pay him back the $50, he needs to be able to take that item and sell it. So he's not going to give you the amount of money that the item is worth, because if he does and he sells it, he's not going to make any money on that. Or if you try to just hand him your item and say, I just want to sell it to you, he has to make money on it too. So he's going to give you this so that he can raise the price and make money off of it. So that's issue number one I have with pawn shops, is that you're never really going to get the true value of the item. If you look at, if you ever watch Pawn Stars, they'll have experts come in and they'll appraise the item at, yeah, this old comic book is worth $800. Great. And then the person asks, all right, what do you want to sell it for? I want to sell it for 800. He's like, well, I can't do that because I have to turn it around and sell it to someone else. He's not going to hold on to something if he can't make money. So the issue number one is that you're never really going to get the true value of your item when you try to pawn it. You receive your $50 loan, and then you have to pay it back. Pay back the loan plus interest, etc., in a certain amount of time. So here are your options here. Pay it back in full, come back and maybe pay another fee to maybe extend that loan for another 30 days. So now you're paying more on top of the loan, or say, I'm not going to be able to pay back that loan and give up your ring. So I think there are two issues here with the pawn shop. Number one, you're never going to get the full value of the item you're trying to pawn or sell. And second of all, you have to put up collateral. You have to be able to put up the item and put it at risk. If that was my grandmother's wedding ring, well, that's a priceless family heirloom. I may never see that again if I don't pay back the loan on time. So I just don't think it's a really smart proposition. You're never going to win with the pawn shop. They're always going to win, whether it's the amount of money they pay you for the item or selling your item. It's never going to really work out in your favor. Okay. Pawn shops, not a great idea. Don't really love it. Next is this concept called a loan shark. I don't know how many of you have any experience with loan sharks, but you probably hear about them in the movies. Let's say, for the sake of argument, you go to your bank and you try to get a loan, and you can't get the loan for whatever reason. Your bank doesn't think you doesn't have a really good credit history. We'll talk more about that when we get to credit. Maybe you don't make enough money. Maybe there's a concern for whatever reason based on your credit history that you don't, the bank thinks you won't be able to pay. And for whatever reason, you get denied the loan from the bank, whether it's a mortgage or a car loan or something like that. Well, instead, you try to find alternative sources of funding and you go to your friendly neighborhood loan shark, and they will be more than happy to loan you the money. Except they typically will do it at an exceptionally high interest rate compared to what you would have paid at the bank. And because you're paying so much in interest, it could take you a very long time to pay back that loan, or the amount of money that you're getting is going to have to be paid back relatively quickly. And if you couldn't afford to get a loan from the bank, chances are you probably can't afford to get a loan from a loan shark either. So the fact that high interest rate is up there is probably not going to make anything any better. Here's what I'm talking about in real numbers. Let's say you go to the bank, your conventional bank loan. I want to take a $12,000 loan out to buy a car. I put some cash up already, but I need to borrow the rest of it. And maybe you're going to say, I'd like to pay that off in 3 years. And the bank says, great, I'll do 8% interest on that. Okay. When you do the calculations, that puts your monthly payment at about $376 and change. So if you pay that off $376 a month for 3 years, that's 36 months, you will then have paid back the bank $13,537 and change. You borrowed $12,000, you paid them back 13 and change. That means the interest you paid was $1,500 and change. This is what we call the cost to borrow. This is how much interest you paid on the original $12,000 loan. Right? So for the privilege of getting to use this money for 3 years, you paid them $1,500 for that privilege. Great, but you couldn't get this loan from the bank, so instead you have to go to your friendly neighborhood loan shark. Same loan, same years to pay it off, except now the loan shark wants to charge you 21% interest. When we do the math on that, that boils down to $450 and change a month. For a total repayment, when you do $452 and change times 36 months, you paid back $16,000 and change. And now the cost to borrow, you really paid almost $4,300 in interest. The interest is what kills you here. Again, never going to work in your favor. If you couldn't afford or weren't in the right financial position if you were not in the right financial position to get a loan from your bank, and you weren't going to be able to pay this, what makes you think that somehow you're going to be able to afford from a loan shark? Not to mention, some of your loan sharks are not exactly the most upright people in the world. So not only will I have to pay a lot more in interest, I also fear for the health of my kneecaps and my close family. Check cashing centers. You may see these all over the place. I know there's one in Avenue U. Avenue U and Nostrand Avenue-ish, somewhere in that neighborhood. But you may see them all over the place. What do check cashing centers do? They do a whole bunch of other financial services that your bank could do, except they are primarily in the habit of the business of cashing checks. I got my paycheck and I want cash now, so I'm going to go to a check cashing center and they would actually convert my check into cash for me. Okay. Couple of issues here. Number one, they're going to usually charge you a fee, either a flat fee to cash a check or a percentage of the value of the check. So the higher the check value, the more you pay to have it cashed. Just recently, I looked up, this is a check cashing center out there called Payomatic, and right now they charge just over 2% of whatever your check is. 2%. Right? So if you're going to cash a $1,000 check, it's $20 to cash that check. The other thing that some people do is what we call like a payday loan, is what they'll call it. It's an advance on your next paycheck. So my next paycheck is going to come at the end of the month. So let's say the 30th of the month is when I would get paid next, but I need the money now. I can basically borrow money against my next paycheck. I need the money now, but when it comes in, I will then turn that paycheck over to the check cashing center. There are probably going to be fees for that, and they're going to charge you interest in the meantime. Even though it's a short amount of time, it could be only a week or two, you're going to charge you interest on that. They offer other actual like reputable financial services, like exchanging currency. Notary public is someone who kind of authorizes documents to be signed. If you have a very sensitive document that need to make sure that you are who you say you are, a notary public kind of witnesses the fact that you actually signed the document, and that's a pretty standard service to offer. Some people do bill payments. I need to be able to pay a bill, but maybe I don't really have a bank account, so I want to go there and have them write a check, and they can help you with that. My issues with the check cashing center first come down to just the cost of all the services. They're high. 2% on a check to cash it is a little ridiculous. And I also have an issue with some security concerns. Quite honestly, I think you see check cashing centers in some of the more poor neighborhoods, which already don't really have a great reputation and maybe are not the safest places to be. So I'm just not a fan. This is some of the typical rates that I've seen. So to be able to cash different types of checks, anywhere between 2 and 4% of the value of the check, et cetera. And there's all sorts of other stuff down here. But not great. And if we back up for a second, and if we look at some of the things that a check cashing center does, they do almost all the same things that a bank does. Well, then just go get a bank account. Sign up for a savings account or a checking account, and your bank can do most of this stuff for you for free. If you deposit your paycheck into your bank account and ask for cash back, they do that for you automatically. They don't charge you a 2% fee for that. Right? So a lot of these things that they offer, you could do through your bank. Why would I not have a bank account and go through and use my local check cashing center? It just doesn't make any sense, especially for the amount of money they charge you. And finally, this idea of something called a debt consolidator. And we kind of used this term before. Debt is money you owe people or loans you've taken out. What they try to do is they try to take, let's say you owe a lot of money to a lot of different people, and you are trying to manage many different statements, due dates, interest rates, and they're all over the place. And it's getting to be a little bit too much. What a debt consolidator will do will try to basically take all the debt you have and bring it down into one amount. They will loan you the money to pay off the debt, right? So you'll pay all your bills, and then you make one monthly payment back to the debt consolidator. Okay, sounds halfway decent. Here's an example. So maybe you have your $30,000 in debt, and here you have two loans going on. One is a 2-year loan. You have $10,000 on that loan, and you're paying 12% interest right now. So you're paying $517 a month on this loan. And here's a 4-year loan. Maybe this is like a car loan or something. $20,000, 10% interest. When we do the calculations, you're paying another $583 for this loan. So that's 2 bills for a total combined of $1,100 a month you're paying to try to pay down this debt. And maybe this is too much for you and you're trying, I can't afford $1,100 a month. Can I drop this payment down? You could. So here's what you might do. Go to a debt consolidator, and the debt consolidator says, great, we will take all of that money you owe, and we are going to give you the money to pay those off, right? So those 2 loans will go away, and you just pay us, okay? So maybe they've consolidated that down to only $640 a month, and we'll do it for you at 9% interest. But the plan here is that you're going to pay for it over 6 years. The cost to pay the consolidated loans, if we do all the math here, maybe when we add in the amount you have to pay back plus your interest, maybe that's $46,000 you owe. Had you just paid the original loans, you could have done it for $40,000. All right. So you paid $5,600 more to get the lower monthly payment. Okay. Really, if you're kind of following what they did, is they were able to shrink the monthly payment because you offered and you agreed to pay for it over more time. If I pay for it over a longer period of time, I can make smaller payments month to month. But the longer you have the loan out, the more interest you pay. As long as you still owe the company money, they charge you interest. So that's part of the deal here is if you want more time to pay back a loan, you have to pay more interest for it. You're paying for the privilege of borrowing their money. So I have a couple of issues with debt consolidators. People will argue that it's a good thing because you can now make your monthly payments more affordable. Because really, at the end of the day, I have to be able to pay this month to month. And if I can't do $1,100, you know what? I'll take it to say that I can only pay $650 because it's the only way I'll make it work. But here's the problem I have. First, we already illustrated that the longer it takes you to pay off the debt, the more you're going to spend in interest. It just keeps piling and piling and piling. $5,000 extra in that example to be able to pay it off over the long term. That's a lot of money. Here's the issue. I also believe it doesn't address the cause of the debt. Why were you $60,000 in debt? Is it because you're overspending on credit cards? Is it because you're not saving properly? You're not budgeting properly? Yeah, this may get you out of the hole now, but it doesn't stop you from digging another hole later. If you're in this scenario where you can't keep up with your debt, chances are you don't have the discipline to change just because we got you out of this hole. This statistic I found somewhere said to me, no, debt consolidation is not good. 78% of the time, even after someone consolidates their credit card debt, the debt comes back. It's because we don't have enough financial discipline in order to handle this. This is the same example, the same analogy of someone being on a diet. Great. I'll go on the keto diet, I'll go on the South Beach diet, and I'll lose weight. But if I don't change my behavior, if I don't exercise more, if I don't watch what I eat, the weight's just going to come back. This is a short-term solution that doesn't really address the root of the problem. That's my issue with debt consolidators. It may cost you more in interest, and it doesn't really teach you any extra financial discipline and practices. So not really a big fan. So all of these accounts that we just looked at sound like a good idea. They sound on the surface like this is an okay thing, but really at the end of the day, you are never going to win. A lot of them have to do with the amount of interest they charge, right? A lot of them have to do with fees and convenience, and a lot of them have to do just with fixing problems in your financial house that you haven't really addressed yet. So if you're looking at these and saying, yeah, these all sound like a good idea, I'm going to say no, not a good idea. Let's just establish good financial practices now, learn to use your banks, and your budget, and you can avoid all these things.